Hello and welcome to CIMA F1 Financial Operations. This is Chapter 14, Principles of Business Taxation. U.S. management accountants and future chartered management accountants have to be aware that we cannot escape tax. In other words, there are two things we can't escape, they say, is death and tax. Hence, while we don't want you to be an expert on tax and the examiner is not looking for that and you don't have a specific tax paper within the CIMA qualification, we want to make sure you have a very broad general awareness of taxes. So here we have for you the categories of taxes you need to be aware of, and I'm sure in your daily life, whatever we call it individual tax, you know about because you suffer it directly or indirectly. So you have income tax that is paid by individuals and is related to the individual's income, corporation tax payable by companies related to their corporation profits, capital gains tax payable by individuals because generally these capital gains are included in the corporation profits and therefore suffer the corporation tax. VAT, value-added tax payable by both companies and unincorporated businesses, and social security contributions, which is pretty much connected to individuals but not strictly a tax as such, but payable by individuals and employers in relation to employees' income. These being the broad categories, also those categories fall into direct type of taxes and indirect. So if you look here at these categories, I'd like to go back. You have, generally speaking, income tax, corporation tax, but talking about companies, you would have here direct taxes and indirect, which is levied on products and services and indirectly paid by beneficiaries, are things like VAT, custom duties, excise. Now, one thing I would like to point out is if you are a corporation, you will have your tax-adjusted trading profit. So in other words, you start from an accounting profit and you are adjusting it for various elements. The one major figure you will have to add are any disallowed expenditure. For instance, protocol expenses or customer entertainment and things like that. Even if they are included here in the trading profit as an expense, you will have to add them back and make them disappear. So I added them back. And what else? Well, you deal with income included within the accounts but not as not taxable as trading income. So there could be a case of some income that we have there but is not taxable as trading income. And capital allowances, which is pretty much what we call in simple terms tax depreciation. So you have a non-current asset, but non-current asset for accounting purposes, let's say, has a useful life of 10 years. So you depreciate with a pattern of a straight line and you divide the value of the asset to 10 years. But for tax purposes, let's say they allow us maybe to have a 20% or maybe make it 80% for the purpose of emphasis write-off in the initial life of the asset. So capital allowance, this in year one, would be completely different with whatever accounting depreciation you have, which is 1/10 of the value of the non-current asset. So that's a capital allowance you're going to have to account for, and you get to the tax-adjusted trading profit. To this figure, you are going to have to add, I'm taking you here, other type of income such as property, interest, any other chargeable gains, and then you get taxable profit. You need to know the rate in that country, let's say 28%, and you apply them to the taxable profits, so not to the accounting profits. That's your corporation tax, and sometimes you may have losses. If you do record taxable losses, depending on jurisdictions, most jurisdictions you can carry them forward and offset them against future profits, but in some jurisdictions you can carry them as well back. So that will be given to you in the exam, but just for you to have an awareness, because you will get a tax benefit from the tax trading losses carried forward. Now, the next thing we would like to look at is the capital items or capital gains. What do we do that in case of companies? First of all, you'll have to calculate, let's say we decided to dispose of a piece of land or a piece of building, and how do you calculate the gain, the initial gain, not the taxable one. Well, the gain on the disposal of a building, let's say, is how much you sold it for, selling price, less the net book value, and that gives you the net proceeds, the gain. However, is that all taxable? No, because we have to take out whatever it cost us originally, so I take that out. Also, any enhancements I've made subsequently to that asset, and then there is, depending on the case, an inflation allowance. All this information should be provided to you, and you know what you allow to deduct from the accounting gain, and whatever you remain with, that is the capital gain taxable, which goes into your total profits to be taxed, total taxable profits. Okay, hope that makes sense. Let's look at value-added tax. Value-added tax, it's an indirect tax, as we said, and occurs when a taxable person makes a taxable supply. So imagine that taxable person. That taxable person will receive for all the incoming purchases documents that will have VAT charged on them. And of course, the taxable person in turn will charge VAT on the outgoings, on the sales he or she is doing. Now, what you have to do is that at the end of each tax period, you have to compare total input with total output VAT, and it's a value-added tax. It's a tax on the value added. Therefore, once you net it off, any excess of output VAT is paid to the tax authorities, whilst any excess of input VAT is recovered from the tax authorities, because that means you did not have any value added in that context. In the UK, you have a rate of 20% VAT from 1st of January 2011. However, you will be given the rate in the exams. You need to be aware that besides the standard rate here of 20%, you have zero rate supplies and exam supplies. Good thing about zero rate supplies, and again, you will be specifically mentioned, maybe you need to, just for illustration, you think of books, for instance. With zero rate, the good thing is, and I will highlight here, you can still claim the input VAT. However, if you have exam, that's an important distinction between zero and exam supplies. You cannot claim anymore the input VAT, so that becomes a cost to the company. So sometimes you have exempt supplies, something like financial services or education and so on, depends on the jurisdiction. Now you have to remember that it's compulsory registration for VAT if you exceed a certain limit of revenues or taxable supplies, and you can do it voluntary registration. Well, on one hand, if you do voluntary registration, you will CIMA business bigger, and of course, on the other hand, you just simply increase your administrative costs, which you have to be aware. So cost benefit. And of course, you can recover the relevant input VAT, which is the ultimate main purpose of registration earlier than you must do anyway. And finally, overseas aspects. Well, you have to just be aware that, let's say you have a branch and that branch is taxed in the country is set. All the profits of the branch come to the parent company and are included in the taxable profits, but then you think, okay, I'm double taxing them, true, and then you would be subject to what we call double tax relief. You will use double tax treaties, and you will deduct basically from the UK tax liability the lower of UK tax on foreign income and overseas tax suffered. So you get what we call a tax credit. Finally, employee taxation. This was a little marathon on all taxes and highlights. Any amounts that an employee receives, wages, bonuses, any form of benefits, even car accommodation, should be taxed under this employee taxation. But usually when employer pays salary to the employee, income tax is normally withheld from the payment, and then it's paid by the company to the tax authorities. That particular step is called PAYE, pay as you earn. Thank you very much for paying attention. Best of luck with your exam preparation and good luck in the exam.